Welcome to our webinar series, Secondary Spotlight, that covers the dynamic world of the secondaries market. Here we explore the opportunities and strategic insights in the ever-evolving secondary landscape. Join us for a discussion with thought leaders that share their views and insights on a range of topics stretching from business, operational, to legal considerations.
Hello everyone, and welcome to another edition of the Secondary Spotlight webinar series here at Arendt. This is the second edition of our webinar in which we highlight and give the opportunity to different speakers of the secondary space to share their experience and guide us through this fascinating topic. Today I am thrilled to have with me Joaquín Alexandre Ruiz from the EIF.
Good morning.
Thank you. Welcome to you, and glad to have you here. So the EIF in the secondary space, that is a fascinating topic and not necessarily a very intuitive one. So for me, the first time I encountered this, I was a bit surprised. For me, the EIF had a very specific role, and I encountered them every now and then as an LP, but wasn't aware that actually you are a very significant player in, at least in the European secondary space. So maybe for those in the audience that aren't familiar with what you do, maybe you can present yourself, your activity, your team, a little bit what you do in the first instance.
Of course. Thanks to Arendt as well for the invite. So the secondaries business started approximately in 2015-16. I had been working for the firm already for a number of years, and as a primary professional. Basically what happened is that in an environment of negative interest rates, we decided to do something with the amount of cash that sits in the balance sheet. As you can imagine, with so many funds under management, the capital calls, etc., we have quite some cash. And obviously, we were not making any returns from that cash at that point in time. Well, the outcome of a brainstorming session, in a way, was to say, how could we leverage the skills we've developed through many years at EIF and put that at work? And we came with the idea of doing something that would not overlap with the mainstream business of EIF, that remains the primary business. So we decided to venture into secondaries. Back in the days, I was essentially given an amount of money, an analyst, and a piece of a white sheet, and we had to start discovering how the market was functioning, who was doing what. And the initial approach was to invest a little bit of money here and there in some secondary fund of funds. The result of these first investments, made me think that actually we should be in a good position to do it ourselves. EIF has, as we speak, over 1,300 fund interests and give or take 600 GP relationships. So it became evident for me and the team at that time that if we were able to find the right deals just by nurturing our existing relationships with the GPs, we would be in a position to do deals ourselves. And we started doing LP trades in funds, in fund of funds. And as the market developed, we shifted towards GP-leds. So that is a little bit the background of how this activity was born in EIF.
Very interesting. That's obviously a great way to start off a business with such backing. And so could you maybe also explain a little bit around team structure, how you are currently set up and how you typically kind of look at deals and then push through them all the way to completion?
Okay, so we have a team of 5 investment professionals, and we've had also a couple of professionals focused on valuation. Our team is, at the end of the day, is part of the primary platform. So we sit in between what has been traditionally referred to as the venture team and the middle market or buyout team. Through that, we are obviously in direct contact with the fund managers. We are ourselves also in advisory boards of quite a number of funds. And that allows us obviously to originate opportunities, be it an LP trade, one client of fund XYZ has approached the GP, I need liquidity. Do you know someone that could replace me? And then the GP would speak to us and we would seal the transaction. Or the GP comes with the idea of a GP-led that has become extremely popular. No? So the team, in a way, again, part of this large platform would have regular dialogue with our colleagues on the primary side. And at the same time, we have organized ourselves through geographies so that we make sure that we know the GPs with whom we want to do business through a GP-led transaction or co-investment opportunity. And we also have distributed the network of advisors that are typically working on those geographies and that, as we know, are involved, especially on the GP-led side, advising the GP to structure a continuation vehicle transaction. So that's how we are basically set up.
And in terms of, LP-led, GP-led, in terms of, without giving away the secret sauce, but can you kind of tell a bit, so you highlighted the evolution that it started out kind of with secondary fund investments and then kind of moved over into LP-leds. How is it very balanced? Is there a shift towards more activity in one space versus the other, or how is it very opportunistic how you look at deals?
So I think we have shifted towards GP-leds, but we still do LP trades. So in our fund, we have an allocation of up to 50% on the LP-led side. I don't think we will get that far. We will probably end up at 30% or a third. The idea being to accelerate cash and generate IRR through these transactions. So these tend to be rich in distributions versus the GP-led, which is more a back-ended game. So you're going to go for transactions that can deliver eventually 2 times, 2.5 times, or 3 times the money even. But you cannot or you should not expect to get a distribution year one, while combining this with an LP trade, which is relatively mature. Not only you put the cash at work, but at the same time, you may be receiving, even in this difficult market environment, first reflows in the first year. So the combination of the two should lead us to a fund that we hope will make something like 2 times the money, but will have deployed fairly fast and will have generated distribution fairly fast, which is also what an LP in a secondaries fund is expecting. No?
Mm-hmm. That's very interesting, the way you look at it and the way you are able kind of to seize on opportunities, because as you just explained, I think, probably there are not a lot of other institutions out there that have that opportunity to, or access to deal pipeline the way you do. Yes. So, obviously the EIF as an organization coming from primary investments and then moving over into the secondary space, is there a big shift in the way you approach deals? I think, again, you'll be more intimately familiar with a lot of the people you interact with, the firms, maybe even some of the assets. Certainly that will have a positive effect on diligence. But is there, other than that, in the day-to-day operations, a huge procedural difference that you would want to highlight? Or is it, within normal variations, still very comparable?
Well, we had to adapt our own governance and processes to be competitive in the market. Things happen at a much faster pace in the secondaries market. No? In that sense, it's very M&A driven, and as a result, when you enter into a process or in a competitive bid, you know that you have 3 to 4 weeks to form a view on the asset and issue a non-binding offer, and then you might have eventually 3 or 4 more weeks to get to a binding bid. And in that time space, you need to plug your due diligence, your investment process, so on and so forth. So one of the first things that I had to do when I was building the business was to think about how do we adapt our own processes so that we can be a player. In terms of the due diligence aspect, if you want, our process is very much primary minded. That's how we've developed as investment professionals. That's how I developed at EIF. And the first thing is always going to be the team, and the team. If we get conviction with a GP that comes with an LP tender process, a strip sale, a GP-led single asset or multi-asset or co-investment opportunity, then obviously the next thing is let's look at the asset. And when we look at the assets, and by the way, this is how we have equipped the team, we are going to deep dive into that asset focusing on fundamental analysis. That is very much similar to what you would expect in a direct deal, especially on the GP-leds. The amount of, I would say, of assessment, of analysis, looking at all the operating models, reviewing the financial models, looking at the vendor DDs. I mean, this is very similar to a direct deal that is combined, again, as I said, with the primary analysis.
Thank you for that. So that's kind of the backdrop where you're coming from, very much the general way you operate. Maybe we can now drill down into some specific experiences or complexities of deals that you've done recently. I think that's always something that's very interesting to kind of hear some war stories, if you will. What worked well? Where did you have some unexpected hiccups? Where there were some last-minute changes? Are there any things you can share, maybe out of recent experience, where you've had some challenges?
So I think, the secondaries market remains a highly competitive market. So every person that I have recruited in the team, that has joined us in the team, I have been trying to make sure that that person understands you're going to be shooting at a lot of transactions, and many of those won't happen. And they won't happen because someone is just putting more money, and also because you're going to find something maybe in the last minute that just doesn't work. In a primary context, you have much more time to do your work, and to start with, also the work is different. But in a deal like this, you won't have a lot of time, and you need to come to a commercial decision. Yes, we want to do that, or not, or should we favor that other deal that has more chances to happen than this one? And that happens, again, in a very short period of time. In the last, I would say, 12 to 18 months, we've been doing LP trades, so buying out a large pension fund that was trapped due to liquidity into a number of funds. They tried to go to the market. The transaction failed. They were trying to sell a big portfolio of funds, and our understanding is that it didn't work in terms of pricing. And we were able to capture the deal. The GP was not very happy with that LP selling their position, and they proposed us to enter into a deal, again, that had failed, and seize the transaction. We are, for example, right now working on something that is becoming popular in the secondaries market. One of the trends, by the way, that we see often on the secondaries market is that it is reinventing itself almost every year. And now we're seeing one type of transaction which is referred to as a co-investment continuation fund. What is a co-investment continuation fund? So it's a situation, imagine you've got a fund 2 or fund 3 that has one asset, and the GP plans to sell that asset into their successor fund that will take one piece of the cake. But the deal is of a size where you need co-investors. So you would have a co-investment vehicle sitting alongside Fund 4, and at the same time, you will have investors in the predecessor fund willing to continue in the asset, plus secondary buyers coming alongside the Fund 4 or Fund 3, irrespective of the number. That is a deal that is becoming popular, but is not exempt of complexities, because you have different types of investors. Some pay fees, some pay carry, some don't pay carry. We, for example, as a co-investor, given that we are an existing investor in the main fund, we don't pay economics. That will mean there are different waterfalls, there are different interests. You need to pay attention on how these two vehicles are going to coexist together. If everything goes well, no problem. But if you encounter problems, then obviously that needs to be tackled properly in an LPA negotiation, co-investment agreement, so on and so forth.
Indeed, complexity seems to be the name of the game. These are obviously very interesting deals, and as you said, it's a very dynamic space where it feels like, once there's a new trend that's established, very quickly it's become the norm, and then you move on to the next variation of that. Just before we were talking a little bit about the timeline, right, which is becoming longer and longer for even for single asset deals, where after having made the initial conviction that you want to go ahead, but then actually completing takes quite some time. Is there any way you think that will change, or is that just inherent kind of to this activity, or do you think that with even more experience and sophistication, things like that will have a even more condensed timeline going forward?
I think the secondaries market has always been a very sophisticated market. and having the I would say the benefit of having done a lot of primaries, having built co-investments at EIF, and also now having developed secondaries, I have seen that it is indeed a complex business. Now, we need to understand the market environment in which we are. Fundraising is difficult, and it's difficult not only for one GP that wants to raise its plain vanilla blind pool. It's difficult also for GPs that want to move assets, trophy assets, let's say, from an existing fund into a continuation vehicle. And these deals tend to be quite sizable. I mean, over time, the asset has grown in the fund that is selling the transaction. The deal I just mentioned is a 300+ million enterprise value. I mean, it's a big deal, at least for the lower middle market. So fundraising is an issue. We as buyers, we have become extremely careful with the type of deals we want to underwrite. Have we seen the bottom of everything that is going on with the macro environment that is pretty complex? What is the implication of, interest rates are still high, inflation is still high, depends on the countries, but overall it is still a high inflation environment. And we want to see those assets develop until we're basically writing the check. So I'm not surprised that it's taking quite some time to close these deals. I, however, see that the LP base that is on the selling fund has become more sophisticated, more used to these type of transactions, that is easing the GP to get a deal done through at least LPACs, etc. And at the same time, the sophistication on the buyer community. We are even seeing direct firms moving to GP-leds, by the way. I think this will help the process becoming a little bit perhaps shorter, but not on the short term. It will take some time.
And you mentioned just now that the overall macroeconomic circumstance obviously impacting the activity and it having to be put into context. I heard that you did mention some challenges which are objectively and undeniably there.
Of course.
Nonetheless, I mean, we're at the beginning of 2024. It's always a good time kind of to take out the crystal ball and look into the future. How do you see things developing over the next year? Is it cautious optimism? Is it a bit, agnostic? Where would you see yourself on the spectrum of bullishness versus maybe rather a bear mindset?
I'll be bullish. I'll share a few data points. In the last 10 years, the secondaries market has had a CAGR of something like 15 to 16%. It's from far the fastest sub-asset class in terms of growth when compared to other ones. There are many practitioners in the market that are recurrently saying this market in 10 to 15 years will be a trillion market. And I'm one of those. I think we're just at the beginning of the curve. Last year was the second largest year in terms of volume. It's 115 billion compared to 102 or 3 the year before, and the record year, which was 2021, with over 130 billion. So in a difficult market environment, the market managed to reach 115. The market is still complex, yes, but when we see the activity of the beginning of the year, it's much, much better than what we experienced more or less at the same time in Q1 2023. So I see good elements there, good grounds for the market to be once again, I would say a big volume market, probably 130, 140 billion. So a record year, I would say.
Good. Very glad to hear it.
Thank you.
I think we share your optimism. So this is definitely something that we here at Arendt are very excited about as well. And we'll see what the future holds. Joaquín, I'm afraid the time is up, but this was very, very interesting. So thank you so much for sharing the insights and telling, for those very few out there that didn't know about the EIF secondary activity, now they know. So thanks for sharing your insights, and looking forward to sharing more in the future.
Thank you very much.
Bye-bye. Thank you.
Thank you for listening. We hope you found it interesting. If you would like more information about secondaries, we invite you to visit our website, www.arendt.com. If you don't want to miss our latest episodes, please feel free to subscribe to our newsletter to receive our invitations.